Hello traders! Welcome to another electrifying episode of Trader DNA. Let's face it, trading without the skill to identify valid and high quality order blocks is like sailing without a compass. It's incredibly risky and can lead to significant losses. Yet order blocks, often overlooked by many, are absolutely vital for executing precise trading opportunities. They're the foundation of any smart money trader's strategy, and ignoring them is like leaving profits on the table. Here's the challenge. Many traders struggle to pinpoint valid order blocks, and that lack of skill puts their trading at serious risk. That's why in today's advanced episode, we're diving deep into the world of order blocks. We'll explore different types of candlestick-based order blocks and the price actions associated with them, giving you the tools to spot these golden opportunities in the market. But that's not all. We'll also break down the key criteria and rules that elevate an order block from just another price zone to a high probability trading setup. By the end of this video, you'll have the confidence to use these insights to enhance your trading performance. So if this sounds exciting to you, give this video a thumbs up to show your support, and don't forget to subscribe to the channel if you're new here. Let's get started, traders, because this episode is going to be a game changer. Right, traders, let's jump right into it. Today, we're diving deep into the intricacies of order blocks and defining exactly what they are. In a bearish scenario, an order block refers to the zone corresponding to the last bullish candle before a sharp, substantial downward movement that results in a valid structure break. Similarly, in a bullish scenario, the order block corresponds to the last bearish candle before a sharp, substantial upward movement that leads to a valid bullish structure break. Now, let's explore the psychology behind these zones in the market. The theory supporting these zones as potential reversal areas is based on the belief that they represent manipulation zones formed just before significant market movements. Traders view these areas as regions where large amounts of buy or sell orders have been executed, and by incorporating these zones into our trading strategy, we can capitalize on the high probability of price reversal and a potential change in direction when price reaches these zones. But hold on, there's more. Next, we're going to discuss how to identify valid order blocks based on candlestick patterns, and we'll go over the different scenarios you might encounter when identifying candlestick-based order blocks on your charts. In a bullish scenario, a candlestick-based order block refers to the last selling candle before the price begins to push upward drastically. This candle typically breaks below or effectively sweeps the liquidity of the lowest point of the previous candle. For instance, in the bullish diagram, we identify this red candle as a valid order block. It acts as the last bearish candle before the price initiates a sharp upward movement, having taken out the lowest point of the previous bearish candle and effectively sweeping its liquidity. Similarly, in a bearish scenario, a candlestick-based order block refers to the last buying candle before the price starts to push downward drastically. This candle usually breaks above or effectively sweeps the liquidity of the highest point of the previous candle. This is the core concept of identifying order blocks, and understanding it can significantly improve your ability to trade effectively. Now let's dive into the crucial criteria and rules that we need to consider when identifying valid order blocks in the market, and understand how we can use them to our advantage. It's important to note that for an order block to be confirmed and valid, the price must first sweep the liquidity above or below the previous candle to form a valid order block. Secondly, the price must leave inefficiency behind and create an imbalance near the order block area. If there's no proper imbalance in the subsequent candles, the identified order block can't be considered valid. Rule number 3 states that the order block must be unmitigated. Order blocks are considered one-time use, which means we focus on trading opportunities only when the price first enters an order block. Once the order block has been mitigated, we no longer view it as an area of interest for future trades. Rule number 4 emphasizes that a high-quality order block must lead to a break of structure or a change of character in the market. These breaks of structure or changes of character are essential signals that indicate whether the market will continue in its original direction or experience a reversal. To solidify our understanding of order blocks, let's go through more examples to reinforce these key concepts and make them even clearer. Take a closer look at this sequence of bullish candles as illustrated. Notice how the market momentum was bearish until a weak bullish candle emerged just before the price surged upward with three powerful green candles. This weak bullish candle reached its lowest point here, and more importantly, it swept the liquidity below the previous candle, setting the stage for the upward push. As we've emphasized before, without proper imbalance in the subsequent candles following an order block, the identified zone cannot be considered valid. Now, if we analyze this three candle sequence closely, we see something crucial. The upper wick of the first candle and the lower wick of the third candle do not overlap the body of the middle candle. This creates a clear gap, representing imbalance, a key confirmation of a valid order block. Looking further up, we see yet another drastic upward movement. Here, a red candle, representing the last bearish candle, forms just before the price shoots up. This candle not only sweeps the liquidity below the previous bearish candle, but also leaves behind a proper gap between the three sequential candles, meeting all the criteria for a valid order block. This makes it a powerful zone with the potential to reverse the price if it pulls back and mitigates into the block. However, not all candles qualify as valid order blocks. For example, further up, we notice another bearish candle that precedes a bullish movement, but this candle fails to take out the low of the previous candle, disqualifying it as a valid order block. These fine details are the key to mastering order block identification. Let's take a closer look at more examples. Once again, we notice that the price has reached the lowest point of the previous candle, effectively sweeping the liquidity beneath it with this bearish inverted hammer candle. This gives us a potential candidate for a valid order block. However, there is no visible imbalance between these three candles, and the order block is mitigated by the upper wick of the bullish candle. As a result, this order block cannot be considered valid as it fails to meet most of the necessary criteria to validate an order block. Therefore, it cannot be used as a demand zone. When faced with scenarios like this, where price sweeps liquidity from the previous candle, but the order block is mitigated or fails to create inefficiency, we consider the next candlestick as the valid order block. In this case, we identify the bullish candle as the valid order block instead of the previous selling candle. This decision is based on the fact that price has created a proper inefficiency or imbalance right after the bullish candle. Looking a little higher, we see that price has once again reached the lowest point of the previous candle, effectively sweeping liquidity beneath it with this bullish candle before price starts to push significantly higher. However, there's no visible imbalance, and this order block is mitigated by the wick of the upper candle. Therefore, this order block cannot be considered valid and cannot be used as a demand zone. Moving on! We again observe a significant upward price movement. This red candle represents the most recent bearish candle before price dramatically pushes higher. Clearly, this bearish candle has broken through and effectively swept liquidity beneath the previous bullish candle. Since price has also created a proper gap between the three consecutive candles, and there is no mitigation, all criteria for a valid order block are met. Therefore, we can now consider this candle a valid order block. This concept applies to bearish markets as well. It's important to note that these principles can be applied across different time frames and price action charts. Now let's move to an actual chart and integrate all the concepts we've discussed in this video. We'll dive into how to effectively identify valid order blocks in the market. I have a 15-minute time frame chart on the screen. As you can see, the overall market direction is in an uptrend. After analyzing the chart, we notice that price has formed a bullish structural breakout by breaking and closing above this key high point. With the emergence of a BOS, break of structure, our focus should now shift to identifying the order blocks related to this BOS. This red candle at the extreme represents the last bearish candle before price starts pushing significantly higher. This candle successfully swept the liquidity beneath the previous one. However, upon closer inspection, highlighting this candle shows that the order block is mitigated by a small upper wick. Therefore, we cannot consider it a valid order block. Looking slightly higher, we see another bearish candle that represents the last one before the price makes a strong upward push. It is clear that this candle has broken through the low of the previous candle. Upon highlighting it, we notice that this candle is mitigated by the upper wick of the bullish candle. As mentioned earlier, if the order block we identify is mitigated by the last candle in a series of 3 candles, we should consider the next candle as the valid order block. Thus, this candle serves as our valid order block. Continuing on, in the next sequence, we observe that price starts another upward movement. This bearish candle is the last one before the upward push. It has broken the low of the previous candle. However, when we highlight it, we see mitigation by the wick of the third candle, reflecting the scenario we've discussed earlier. As a result, we identify the next candlestick as the valid order block. Once again, it is mitigated, this time by the upper wick of the candle. Therefore, we proceed to the next candlestick. Traders, the hammer pattern that follows is our valid order block. However, upon closer inspection, we notice that price touches it and after a small reaction pushes lower without respecting the order block. The main reason for this price action is that we must always wait for price to clear inducements before executing any buy-sell positions. We've covered this topic in a previous episode and I will add links to other order block strategy videos in the description box at the end of this video. Or I highly recommend browsing our channel for a more comprehensive understanding. Next, we see that price continues its downward momentum, enters our valid order block, experiences a reversal and then pushes higher. If we analyze this live chart, this order block would provide us with a great opportunity to execute a long position and enter the market. Then we see that price has formed a character change pattern by breaking and closing through the structure. After a character change occurs, it's crucial to wait for price to clear the inducement before considering a long or short trade and entering the market. In this case, the low of this candle represents the most recent internal level formed by price in its upward path. So after the market clears this inducement, the next step is to wait for price to return to the valid order block we've identified. In this scenario, this red candle represents the last bearish candle formed just before price dramatically pushes higher, sweeping liquidity beneath the low of the previous candle. Additionally, there is a visible imbalance above it. Therefore, this candle is our valid order block, offering a high probability of price retraces. If price taps into it, we should consider entering the market with a long position. Traders, we've thoroughly discussed the main order blocks that frequently appear on real price charts, giving us a strong understanding of how to identify them. That's a wrap for today, traders. Thank you so much for tuning in. I truly hope you found this video both informative and valuable. If you did, don't forget to hit the subscribe button and turn on notifications so you never miss out on our latest content. We love hearing from you, so feel free to leave your thoughts and suggestions in the comments below. Let us know what topics you'd like us to dive into next. Your support means the world to us, and we can't wait to see you in the next episode. Stay tuned and keep trading.